Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
3 things to consider ahead of the FOMC January 2026 decision. Pause. This article was written by Chris Lau. Summary. Pause.
While the FOMC is expected to hold rates steady at 350 to 375 basis points,
The statement and commentary will likely move stock markets. Persistent inflation above the 2% target and modest wage growth reduce the likelihood of imminent rate cuts. Recent economic data, CPI, non-farm payrolls, and GDP suggest the Fed will maintain a cautious stance, prioritizing inflation control. Investors should monitor currency weakness, metal price surges, and tariff developments for portfolio positioning. Chris Lau, an economist, science major, and project management professional who leads DIY value investing. On January 27-28, 2026, the Federal Open Market Committee, FOMC, will meet to discuss its monetary policy. Ahead of the decision, the CME FedWatch tool has a 95.6% probability that rates will not change. While the target rate stays at 350 to 375 basis points, stock markets and the current U.S. government administration may view no rate cuts as defiance. Stock markets want lower interest rates to justify a lower risk premium. The S&P 500, SPY, IVV, SP 500, is up by 1.07%, underperforming markets like South Korea, EWY, and Peru, EPU, year-to-date. Chart readers might notice the bearish multiple top on the S&P 500. Although readers cannot rely on the chart indicator, the FOMC is a potential catalyst for the downside risks ahead. Japan's EWJ, 10-year and 40-year Treasury bonds are at multi-decade highs. Citadel's Ken Griffin said that Japan's troubled bond market is a warning to the U.S. to get its over $38 trillion national debt in order. Still, fiscal policy is beyond the FOMC's mandate. It sets interest rates to achieve maximum employment at a stable inflation rate of 2.0%. What will the FOMC say after it likely holds interest rates? Readers have 3 considerations. 1. PCE inflation at 2.8%. In November 2025, the Personal Consumption Expenditure Price Index showed that both headline and core inflation were 2.8%. This is above the FOMC's 2.0% target. In October, the Bureau of Economic Analysis, or BEA, reported a 2.7% figure for both core and headline. Core inflation excludes food and energy prices, since they are volatile. The Fed might assign a lower weighting to those 2 figures. The federal government shut down during that time, limiting the data's durability. Fortunately, it had more complete December Consumer Price Index and non-farm payroll reports to review. Wages increased by 0.1% in October and by 0.3% in November. That helps consumers limit the impact that inflation has on their disposable income. That is showing up in corporate earnings reports. Procter & Gamble PG Chief Financial Officer Andre Schulten said that its most recent quarterly report represented the softest quarter of the fiscal year. Still, the global conglomerate offset domestic weakness with strong growth in France, Spain, and Italy. That offset softer demand from Germany. Seeking Alpha's peer tab on PG stock is a source for further stock ideas. In the monthly chart above, all of the consumer staple stocks are up. Colgate-Palmolive, CL, Reckitt Benckiser, RBGLY, Kimberly-Clark, KMB, Henkel, HENOY, and Church & Dwight, CHD, have positive returns. The quant rankings below show that RBGLY stock has a higher industry and sector rank than PG stock. 2. December CPI. Last month, the CPI increased 0.3% on a seasonally adjusted basis. CPI for all items in the last month increased 2.7%. The index for shelter increased 0.4%. It contributed the most to the monthly increase. Homebuilder companies like D.R. Horton, DHI, started to rally before losing momentum. Lennar LEN shares spiked to nearly $125 before they pulled back to $111.84. LEN stock lost 8.52% last week. Irrespective of the Fed's monetary policy, the Treasury bond market is anticipating the US dollar, UUP, DXY, to weaken. Yields for longer-term bonds like the 7 to 10-year Treasury bill, IEF, and 20-plus-year Treasury bill, TLT, continue to trend lower. Throughout this year, investors aggressively hedged their bets against the currency. They sent gold, GLD, toward $5,000. Silver, SLV, traded at a milestone of $100 an ounce. Despite fears of U.S. aggression toward Greenland easing, watch out for the currency weakening further. Just as investors are bidding non-U.S. indices higher in 2026, they are also potentially creating a bubble in the metals market. 3. December non-farm payroll data. On January 9th, the Bureau of Labor Statistics reported that employment increased by plus 50,000 and the unemployment rate of 4.4% changed little in December. However, it revised the NFP for October down by 68,000, from minus 105,000 to minus 173,000. It also revised November figures by 8,000, from plus 64,000 to plus 56,000. Readers may infer that the Fed would estimate that the BLS will revise December figures down by an average of those two figures, or by around 38,000. The smaller monthly job decline would sharply decrease the odds of the Fed cutting rates this month. Instead, inflation rates above its target would encourage the FOMC to hold rates. Even though a rate hike is not impossible, it is also not likely to happen. Besides, investors should wait for Fed Chair Jerome Powell to comment on the upward revision in the Q3 2025 gross domestic product. The BEA reported that GDP in the third quarter topped 4.4%. Despite fears that tariffs would hurt trade, U.S. exports increased, lifting the real GDP reading up by 0.1%. The waiting game on the legality of tariffs also has an impact on GDP, while exporters wait for the Supreme Court to rule on the matter. In the meantime, the U.S. president threatened to impose a 100% tariff on Canada, EWC. This is in reaction to the country making a trade deal with China. Investors may take advantage of the tariff noise. Consider buying Canadian Natural Resources, CNQ. After the U.S. removed the Venezuelan leader, markets initially mispriced CNQ stock. It was thought that oil supplies from the country would hurt Canadian exports. But since those are different markets, CNQ shares almost immediately rebounded from a low of around $30 to close at $36 on January 23rd. Your takeaway. At the question and answer session following the FOMC statement, expect mainstream media to ask Fed Chair Powell about the Justice Department's investigation. Powell already issued a public statement at the time. That proactive response should shift the media's attention back to the rate decision. Some of the more insightful questions the media might ask the Fed include its view on the US dollar's slump compared to the rise in silver and gold. The rising national debt is a fiscal matter. However,
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.